It's time we tackle an uncomfortable but urgent question. As fresh capital flows back to African tech, are founders being asked to shape up, or are investors imposing a foreign playbook that doesn't fit local realities? To help us unpack that is Damilola Thompson, a practitioner who's worked both inside VC and now runs Diligence Africa, a firm that helps investors and startups perform smarter, faster, and fairer checks before deals are done. Expect honest, practical answers about what investors actually want and what founders must change to build enduring businesses. So, as promised, we have with us on the show Damilola Thompson. She's the founder of Diligence Africa and a tech innovation expert. She specializes in due diligence, risk intelligence, and investor readiness across African markets. It's good to have you on the show with us today, ma'am.
Great to be here, Gabriella. Thank you so much for having me.
All right, so I wanted to dive right into it because I have a lot of questions. This is a bold topic that you obviously had to pick that we talk about. And it's great that you're obviously the expert on the field to talk about this because this is something that a lot of people I would say the startups, there are some things I'm pretty sure you'll be sharing with us here that they do not know about, the founders do not know about, and of course the investors. We get to look at it from both angles, from the startup founders to even the investors' angles. So it's great to have you on the show again with us.
Thank
So
you.
thank you. So let's talk about the fact that you created Diligence Africa to normalize good due diligence in African deals. From your work, why do you think we're seeing an intensification of diligence now? Do you think it's just a reaction to poor returns or probably a deeper maturation of our market?
I think it's more, again, thank you for having me here. I think it's more the market maturation because I think that we're at a point where investors are starting to look more deeply about into businesses and starting to
Okay.
query things and starting to ask more questions. You also have the same thing sort of on the local investor side and also on the foreign investor side where people are starting to understand that sometimes what appears or what things seem like it's not really what it is, and so there's a lot of undertone, and sometimes there's a lot of data that needs to be assessed or evaluated, to really understand the business beyond the pitch deck, beyond sort of initial documents that are provided to the investors, and that's the work that we do. So it really is as a result of market maturation. I think investors are also starting to understand, and even founders, some founders that we've worked with are starting to understand how critical and even useful due diligence is for
Yeah.
them. It's not just looking for faults in a business or looking for gaps. It's really helping you as a founder understand why due diligence matters. What are the things that you're not seeing that an outsider looking into your business can see and can understand about your business that you would not see because you're there every day looking in.
It's great to know that this is not just something that it's just coming out of the blues. It's good to know that people are beginning to take due diligence into consideration, and it's not just coming out because of we are seeing poor reactions or precisely poor returns actually to the market, and it's something that is important to note that it's a step obviously in the right direction, but it doesn't take away the fact that there are some misconceptions that obviously still comes into play. Now, if we want to make
Yeah.
emphasis on the fact that across the continent, founders often celebrate moving fast and, let's say, breaking things. Yet, we still have global investors that emphasize structure. We still have those that emphasize in compliance and risk management. Many say, though, that Africa's ecosystem glamorizes disruption, but we get to underplay diligence. From your vantage point on both investor and founder sides, is Africa's startup ecosystem truly balancing disruption with diligence, or are we leaning too far on one side or too far to one side?
So we're we're at a point where we have over indexed on all the good news of fundraising and funding rounds, and founders closing, and honestly that is such a huge milestone. And this is not to discredit anyone's fundraising because it takes a very long time to fundraise. Even the
Yeah.
journey to fundraise is venomous, let me use that word. But I think that there's a lot more, there's a shift at the moment to, okay, what did we do in the past that we need to fix? And it's very good that a lot of investors are starting to see that, and even founders are starting to see how important due diligence is. So you've come to a point where we previously underestimated and over sorry underutilized due diligence because people thought it was a nice to have, honestly.
Yeah.
But now with everything that has happened in the past 3 4 years, investors and founders are starting to see that due diligence is as important to them as it is for investors and as it is for LPs.
Okay.
With fund managers, when they're fundraising, one of the critical things that the LPs ask them is, what is your process of due diligence? What is your due diligence process? And because they are asking those questions, fund managers are now asking those questions to portfolio companies that they're looking to invest in. Like, we're going to conduct due diligence. This is our due diligence checklist. We need you to provide us with this documentation. We might be introducing you to someone who's going to handle a part of the due diligence, like Diligence Africa
Yeah.
and some other people. But I think there's a lot more focus now on diligence. There's a lot of balance also, I would say, between disruption and diligence. But I think things are way better now than before because both sides are starting to understand how critical due diligence is.
Okay, that's very good and obviously good to note. Let's move down to where we say founders tend to fall short, or when, should I say, investors say founders tend to fall short. Now, there's this recurring complaint among African founders, and it's that international investors subject them to deeper scrutiny than startups that are obviously in the Western markets. We get to hear that sometimes they're demanding a level of documentation that even Silicon Valley early stage startups or companies don't even have that, or don't even map neatly. You still have other documentations that don't get to even map neatly to local markets. Do you think this reflects a systemic bias in how global capital views African innovation? And obviously, from your due diligence work, which investor metrics cause the most friction, and which ones do you think are genuinely useful for African startups to adopt?
Hmm. So I definitely think that there's a lot more scrutiny on the African continent, and that is as a result of several things. I think that
Okay.
there's also so many narratives about what Africa is, the investment landscape on the continent. Our regulatory environment is also not the most friendly, to be honest. And I think that when you combine all of these things together and bring them together in a way that's, especially for foreign investors, there's a lot of concern about, if I invest in this market, would I be able to recoup my investment? Or if there was something that happened, can I really go to the law courts and get justice for the investment that I've made? And so that's what you're starting to see just sort of crop ups. And so you have things like, obviously, our political climate across the entire African continent, not just in Nigeria or Kenya or Ghana.
Okay.
You see that a lot of investors are worried about, changing government. Like, for example, what's happening in Guinea, where now the military has taken over because the two candidates or contestants decided that they both wanted to be presidents. You're
Yeah.
also starting to see situations where the FX climate is also fluctuates across the continent. Some markets are obviously more stable than the other, and then you have situations where even if you go to a law court, the regulatory environment is changing. Not just the law courts, the regulatory institutions like the CBN, the central banks across the different countries. You see situations where someone is banning crypto and then validating or approving crypto the next day. So people see, external investors see all these changes and are just
Yeah.
worried about how stable the markets are. And so these are the things that they see. A lot of times they don't see the innovation. A lot of times they don't see the all of the good things that are happening on the continent, all of the disruptions that are happening on the continent, because there's
Yeah.
so much innovation on the continent. But then when you combine that with the FX risk that I mentioned previously, and then
Yes.
even some of the issues that have happened in the African startup ecosystem about founders mismanaging money and fraud, when you combine all of those things together, those are the only things that people see, that investors see. And so I think for us as local investors, one of the things that we have to do is make sure that we're not just investing in our own people, but making sure
Mm.
that the stories that are getting out there are stories that inspire people to want to come back to invest. Some
Yeah.
of the metrics that I think that impact founders the most, I would say reputational risk is a big deal. Is a big deal. We're starting to see a huge demand for reputational due diligence now this year more than last year. Our request
Okay.
for reputational due diligence has honestly skyrocketed. Previously, even I would say right now it's financial due diligence and reputational due diligence. Both of them
Mm.
sort of take the lead. Obviously, you have lawyers that do legal due diligence, so you still have that, and that will always be standard. But in terms of
Yes.
like other types of due diligence and risk that affect businesses, and even instances where deals do not go through, the two key major ones are financial task and tax and reputational due diligence. So those for me would be the things that impact deals and transactions the most that we've seen this year.
All right. So aside from the concern of excess scrutiny, we can take away the complaints of overdependency on most of these foreign visas. We get to see a lot of founders are trying so much to tailor their entire strategy just to obviously, should I say, appease them, just to obviously strengthen this entire strategy or strengthen relationships with foreign investors, or trying to make sure that their strategies obviously match foreign expectations, sometimes at the cost of local relevance. Should the ecosystem aggressively prioritize growing local pools of capital, or is global capital still the best path forward?
I think that we definitely need to create a balance. I think what we have right now is an influx of global capital, where
Okay.
the capital that dominates the African continent is from outside. It's not
Mm.
local. And when I say local, the source of the funds, not just the fund managers, the source of the funds that even the fund managers are raising from is from foreign investors and not from local
Yeah.
investors. I think that for the continent to grow, I think that there's a place for local investors, local organizations, local corporate organizations, local rich men, wealthy people, local family offices to start to think about how can I make sure that whatever I'm building on the continent actually remains, and then I'm able to reinvest some of the funds that I have into businesses that I think are doing well. And again, that's the role that due diligence plays, because when you invest your business in a you invest your funds in a business that is doing well, you will
Yeah.
definitely get a return. But I think that many local corporate organizations and local family offices and even just like wealthy families don't really understand what is going on in the local investment landscape.
Okay.
And again, I'm speaking from the technology side because obviously you've seen, investments in mining, in
Yeah.
cement, in infrastructure, but you're
Yes.
not seeing a lot of that in terms of local capital from local investors. So I think there definitely needs to be a balance. Um, One of the other, sort of things that we've heard is also that if local investors are not investing in our companies locally, then why should
Mhm.
foreign investors do the same? Because
Mm.
now it almost seems like foreign investors are the ones giving validation to our businesses, and that's not what it
Businesses. Yeah.
should be. It
Yeah.
should be local capital plus global capital working
Capital.
together, complementing each other to
Yeah.
invest in the African market, because you also have a situation where when businesses grow and they scale and they raise more funding, what happens is that the existing investors exit those businesses so that bigger
Mm.
investors can come in. Now, if bigger investors are not coming in, that means that existing investors that have, that didn't put a lot of money also don't get to
Mm.
exit the business on time. And so
Yeah.
that stales, creates an economy that doesn't necessarily grow the investment landscape, but really puts it at I won't say a stop. It's just
Okay.
growing slowly, as opposed to growing rapidly, where there's more local capital, there's additional global capital to sort of complement and support that. But I think it's not an either or. It definitely needs to be like a complementary. It definitely needs to be complementary in the sense that um, for us to really grow, honestly.
Yeah. Okay, so still on the founders table before we obviously move into where we're talking about investors' behavior and all of that. If we're focusing on the aspects of most of the struggles that most of the founders obviously face, there's governance, there's also the clean cap tables, predictable revenue lines, and like you said, legal readiness. Which of
Yeah.
these areas would you rank as highest priority for a founder that's preparing for global capital? Maybe not any of the
Yeah.
ones I listed, and of course, why?
So I think ultimately one thing that I always tell founders is the best money that you can get is your customers' money. That is everything. So you can raise additional funding and build a really nice cap table, and your cap table has like fancy people on it, or like really solid investors. But if you're not growing and if you're not generating additional revenue from your early days, your business will break. Your business will go down the drain. And so the best, I would say the first thing that you should stick with, the first thing that you should focus on for every business is grow your revenues. Because even as you're fundraising, one of the things that happens is that founders forget that in the process of fundraising, your business still has to grow. If your business is not growing as you're fundraising, investors will think that your business is not really doing well. And so they're asking questions like, how much runway do you have? And if you tell some investors, oh, you only have 2 months of runway or 3 months of runway, they don't want to invest in your business because obviously your business is not growing. So the first most critical thing is making sure that you have enough revenue in your company to continue to grow your business as you're fundraising. Make sure that you have a team that is sort of helping you do that and drive sales into your business. But the most critical thing above anything else, obviously messy cap tables are a big deal. Obviously legal documentations, you do have to have a company before you go out to fundraise. But the most important thing, and even governance is very critical, because without governance, if your business is growing, your business will break. Your business will There's certain things that will happen in your business that you realize that where did this start to go wrong, and you really cannot figure it out, and it's as a result of governance. And I really think that that is something that businesses, a lot of businesses and founders overlook. But ultimately, your revenue is everything, honestly. But the other thing is that as revenue grows, your business grows, your controls grows, your processes grow, and because they're growing, they also break as they're growing. Because it's just like, when you're trying to expand a band, the more you extend it, the more it is prone to breaking. And if you're not putting in the right, like adding additional bands to it, it will break. But the more you add additional bands to it, the stronger it is, and then the more you can really like expand it. So it's the same thing with companies.
Okay, interesting. So let's move away from the founders because obviously, from what we've established with that, this is like we're trying to actually fix and maybe probably probe where the issues are, where we have their problems with, or where their capability lies, or maybe fix the concerns of interns. But let's step away from the founders a bit and move on to where we have the investors. Now, you talked about the aspect that we're seeing a great influx of global capital in Africa, especially in some African countries. But I think there are some African countries who would beg to differ. Because, irrespective of the fact that some other countries are obviously seeing this great influx, it might not be the same for all of us. Because we've obviously seen, I'm trying to go down to the aspect that we've seen this great amount of countless investor readiness boot camps, accelerators, playbooks. They are all over the
Mhm.
place. But the investment
Mhm.
gap, it remains huge. So what's the problem? So clearly, preparing founders is not just the only concern right now. It's not the only missing piece. In your experience, what are the real unspoken barriers that are stopping African startups from, or other African startups from unlocking global capital?
Yeah. I think generally on the continent, one of the reasons I actually started Diligence Africa was
Mm,
um, just a lack of data on the continent, and
okay.
how it was very difficult for investors to make decisions without data, without data about the company. And again, data about the company is not just the company's financials, it's not just the company's, pitch deck. It is what are the other what other data exists in the market that I can use to validate that this business will do well. And a lot of those data is missing, or those data are in silos. They're owned by someone who doesn't want to share it, but it's somewhere out there. Many people have done so many reports that are in so many places that we're not, as a continent, it has been difficult for us to aggregate data in a way that helps other people, helps the entire investment landscape make better decisions. And that's why we founded Diligence Africa, because we felt like we can help investors throw more light into making investment decisions through our own insights in the industry, through the data that we gathered, through different, sources of data that we're able to put together. So I definitely think that one of the things that has impacted us as a continent is the lack of data on the continent, or the lack of a centralized databases that we have. You will realize that many people are building their own databases, but there's no really centralization amongst what people are doing. So that's one critical thing. I think the second thing, obviously, is the narrative about how Africa is dangerous and how Africa is risky, but then you see very similar situations of things that are happening on the African continent also happening in the US or happening in Europe. And then you really, there's a lot of, I would say, bias when founders in Africa make mistakes. And then you compare the same thing to what is going on in the US or what is going on in Europe. You realize that many of those, biases are I won't say unfounded, but are really the same. But when you think about it from an investor perspective, and you combine all of the risk that people see from the outside who are not living on the continent, that's why when people are trying to invest on the continent, we ask them to go to the continent. We're like, go to Ghana, go to Kenya, go to Nigeria, go to South Africa, and really see what is going on the ground. Because without that experience, it's difficult for you as an investor to make a decision to say, oh, this continent is risky. But then when you go on the ground, it really changes your mind, because you really see all the amazing things that people are doing. And you're like, okay, I know certain things are broken, but these things can be fixed. And so that's where the issue of governance comes into play. And what are the guardrails? And I agree with you that there's a lot of training, this, training that. Um, but the thing is, those things are very critical, because what you find is also that there's a crop of, when I was working at EcoVC, one of the things that I found in my time, this was almost 10 years ago, one of the things that I found out was that there were so many founders in the market who really did not understand what fundraising was, didn't know what fundraising was, didn't know how to raise funding, didn't know where to start from, didn't know, like what a term sheet is. And so one of the things that me and a couple of my friends started is we founded a non-profit organization called Ventures Dialogue. It's called venturesdialogue.com, where we were training founders for free on how to raise funding, what to do when you want to start raising funds, how can you better prepare yourself to be a better founder. And we will bring investors into these rooms, because founders need to hear it from investors. And a lot of that is, even though it's happening now, but what you find is that you're having a crop of entrepreneurs who don't have a lot of experience building businesses. In the past, that's what you had. But now what you have is a lot of founders coming from the university who have zero experience about entrepreneurship, and who have zero experience about reputational risk, zero experience about how to store data privacy, or even how to manage businesses, starting businesses, raising so much money without any background on how to run the businesses. So I think honestly, those trainings are still critical. Obviously, the delivery of the training is a different topic, and what is being trained and how the trainings are being done. But I think that those trainings are critical for the ecosystem, because of the educational system that we have locally that doesn't support entrepreneurship. And I think that that is one area that, even as investors and corporate organizations, that's really one thing that we need to do and focus on.
Yeah, that's actually interesting because we can't obviously take away the aspect of knowledge, and this knowledge obviously comes from trainings like this.
Exactly.
But most times it doesn't obviously end that way, because after all the knowledge and all is imparted, actually, we still need to follow up on most of these trainings that have been done. Or else, just like you said, we still have a whole lot of university students these days, even those who are obviously still in school, they're setting up businesses, and then
Yeah,
there is always this notion of, I'm working
exactly.
in a Gen Z company. This is how we operate. We do not take things the status quo or the archaic ways that our millennials used to do it, actually. So obviously we can't take away the fact that, irrespective that they do want to start up organizations and they want to start up companies that should I say, resonates with their generation, it doesn't take away the fact that there are principles that are being set in place that everyone should actually follow, irrespective of whatever generation, Gen Z or, of course, millennial. So, out of curiosity, I want to ask this before we move on to the next question. Who do you think is actually harder to lie to? A local investor or an international VC?
Um, to lie to,
Yeah.
I wouldn't use the word lying.
Okay.
I would say, which one is easier to get
So, okay, let's say
um
easier to convince.
to convince.
Mm-hmm.
Okay, let's use that
All
word.
right.
Because the presumption is founders don't lie.
Mm,
And that's the natural presumption. At least
yes.
in law, you
Yes.
don't lie until you're
You
caught.
don't.
Um, no, I think it's easier to convince foreign investors, and that's
Mm,
that's because they're not on the ground. It's
mm,
easy for I've heard so many stories, you just unbelievable stories
okay.
about how we don't have banks in Africa, and this is like foreign investors telling me
Oh,
that they've
wow.
heard from founders that there are no banks in Africa. I'm like, I'm sorry, someone told you that there
Okay,
are no banks.
that's a huge one. Come on, with and they would buy
Yes,
it.
yes, they would,
Wow.
because again, they're not on the ground. They don't know. And
Yeah.
the presumption about what foreign investors see is we still live in huts.
Yeah.
They go to safari. That's the
Mm,
only Africa that they see.
yes.
They go back to their country. In their mind, people still live on
Two
trees.
trees.
In fact, I think there was a video at some point where I think someone was using an air conditioning, and someone was like, "Do we have air conditioning in Africa?"
Oh,
I'm like, "But
come
where are you
on.
from?"
We'll move past that. Come on.
So I think it's definitely easier to convince foreign investors,
Okay.
and that's mostly for lack of just not being on the ground, and not being present in the situation. And that's why we always advise. So 2 years ago, when there was a lot of influx, 2 3 years ago, when there was a lot of influx of capital on the continent, one of the things that we were thinking about is how can we work with foreign investors to support local investors, to work with local investors to make sure that when they're doing deals, they're not going and at it alone. But that's what we're seeing, where foreign investors will come into the market and would even be telling the founders that they don't need to raise money from local investors because local investors were asking for too many things and asking for too many, their checklist was too long. But the sad part of that was that it came back to bite them, because they met a lot of founders that had ill intentions, that didn't have the right intentions. And some of them obviously did, but the business just didn't do well. But some of them also had bad intentions, and that caused many of the foreign investors to backtrack and be like, okay, we're taking a step back from Africa. I heard this so many times before from a lot of foreign investors who 2 3 years ago decided that they were going to take a step back from the African continent because they had such bad experiences investing in founders and just not hearing anything from them. They give the founders the money. Some of them don't even sign agreements, and then they hear nothing from the founder. All the business goes bad. All the business shuts down because the data that they were provided with was false. And so for us is how can we continue to work with local and foreign investors to ensure that capital that is channeled into the continent is diligence, it is evaluated, and it goes to the right people also. So for us, that for us is part of the critical things that we're trying to solve for.
Okay, so because when we actually talk about this whole experiences, obviously from the foreign visas, it just tracks back to the aspect of over scrutiny, the excess scrutiny that obviously tends to go on. Obviously, they're not just doing this because they want to. There are obviously other reasons, like and they've obviously had experiences like this where they invest in a particular startup or invest in a particular company, just like you made reference to, and we don't get to hear any returns from it, and it looks as if, or they're lying or telling us, or rather trying to convince them, rather let's not use lies, trying to convince them that there are no
Yeah.
banks in Africa. So things like this obviously wants to plunge them to want to make carry out actions like the excess scrutiny, and there's no harm in doing that. I mean, if there's nothing to hide, you shouldn't be actually complaining about any of those things. But
Yeah,
all the same,
exactly.
It still makes sense. So let's move on to the real cost of what it's like. What happens if diligence actually fails? When diligence misses big risk, what are the real consequences for ecosystems? Are we talking short term winners and let's say long term hollow firms, or worse, are we talking capital flight and investor fatigue?
I think it's definitely the latter. I think that when diligence fails or when diligence is non-existent, you have situations like what we've had the last 2 3 years, where capital has flown, is resting somewhere, or is being invested in other types of businesses or capital. Sorry, other types of investments that are not technology, that is not startups. Um, when diligence fails, it affects everybody because some people say, "Oh, we conducted due diligence," but the truth is, what kind of due diligence did you do? One of the things that we've started to see is initially in the past like 2 years, we saw situations where um, investors are no longer relying on management accounts. This is for financial due diligence, relying on management accounts or um, audited financial statements. Because what we've also seen is situations where sometimes even the audited financial statements are not accurate, are not a good and accurate representation of the business at the time. And so we've seen situations where investors are saying, we need you to help us reconcile the bank statements, the money that actually comes into the bank statements. We need you to reconcile it to the management accounts, also reconcile the bank statements, reconcile it to the audited financials, because we want to see those numbers match. And when you do that, what happens is that you're able to tie the money that the founder is saying, oh, we generated this amount of money this year. You're able to tie that exactly to what is in the financial statements. What we've also seen is situations where bank statements are doctored, bank statements are altered or edited to reflect what certain people want the bank statements to show. And so diligence can fail as a result of that. And so for us, we go a step further to make sure that if a document is altered, we want to see the original document. We either ask the bank to send us the originals, or we ask you to log onto your platform to download the bank statements for us, or show us directly on your bank statement, on the bank statement portal. Show us the bank statement so that we can see what we're looking for, and then send it directly to us. So it hurts everybody when diligence fails. It's not just the founder that is trying to raise. A lot of some of the deals that we've diligence and this year have failed because for so many reasons, because there was incomplete data, there was incomplete, the financials did not match. Some of them taxes were had not been paid up the way they should have. Taxes are becoming a very big thing now, especially when you have a huge backlog. FIRS and local tax authorities across the different countries are issuing tax notices to companies, to businesses, especially once you fundraise and they see your business outside. The next thing is you get a tax notice and they're auditing you 3 years back. And then you now need to prove to them that all of the monies that you've made, you've actually paid taxes on it. And so it hurts everybody when due diligence fails, whether it's as a result of diligence not being done properly, or that the diligence failed because the documentation was not accurate, or the investor just did not do any diligence by themselves,
Okay.
and just relied on information that was provided to them, by the founders, by the companies. One of the other things that we do when we're conducting due diligence is that we don't only rely on data that is provided to us by the business.
Okay.
We rely on due diligence, and I think that this is something that many people don't know when they're trying to conduct due diligence. Due diligence is not just evaluating the transaction documents or the documents that the company has provided you. It's looking for third party resources, third party data that you can use to validate the information that the business has given you. That's due diligence.
Okay.
If you don't have third party data that was not generated by the company to validate that information, your due diligence is not complete. It has to be data that has been sourced or provided by somebody else, that has no relation to the business, that is not, tied to the business, is independent of the business. For example, the relationship between a bank and a company, that's third party data. The relation between What other example can I use? Let me Bank statements, honestly, I would say is the most popular thing,
Yeah.
because a lot of times what you find is even though bank statements can be doctored and altered, it can be obtained independently directly from the bank. And so if you're not able to validate, um, as an investor, if you're not able to validate the data that the company has provided you with, the third party data, your due diligence is not complete. And I think that that's where a lot of times due diligence fails, because people only rely on audited financials, they only rely on tax notices, they only rely on management accounts, without actually looking for other areas that, where the business would have gotten additional data from.
So let's shed light on the big name in the room when it has to do with concerns like this, especially when we're talking about startups, founders, and investors. I'm talking about regulation, policies. We know that regulators in many African markets are still catching up with the speed of tech, per se. The results, we get to see ambiguity, we get to see unpredictable policy shifts, and then we even get to see other cases of compliance nightmares that tend to scare investors away. Do you think African regulators are ready for the type of global capital that we're obviously trying to attract?
I definitely think we are. I think we're already there. Um, I think investors are ready. I think investors have been ready. I think that sometimes the country itself needs to get to a place where we were creating an enabling environment, not just for investors, but even for businesses to thrive. And I think that is one of the biggest barriers in growth and scalability on the continent. Because what you have is when a particular sector is doing well, the first thing that a lot of regulators do is look for ways to put a stop to it, just so they can figure things out. But why can't you call a town hall meeting and say, you guys are doing this? We want to understand how this works. We want to understand how to better support you. We want to understand how to ensure that people are not taking advantage of this situation. It's very similar to what has happened with um, just banks being set up across across the continent, and people taking advantage of people's money and taking people's money, and then just shutting down the bank one day. A lot of a lot of there's been a lot of issues. People have lost so much money from those kind of um what do you call them now, Ponzi schemes. So I think that for regulators, that one of the key things I would just answering your question is, how can we ensure that as regulators, that regulators are supporting uh, a thriving are supporting a thriving ecosystem, investment landscape on the continent, to make sure that when monies are coming into the continent, it's not being stifled. That's honestly one of the best things that regulators can do for the continent. Also, with things like, that I mentioned previously around enforcement, when people realize that it's very difficult to enforce bad behavior, or to enforce good behavior, or to enforce good judgment, or to get judgment for their cases, it's very difficult for people to have the confidence to want to invest in the markets. So I don't think it's a situation of the investors not being ready. I think the regulatory climate needs to get to a point where everyone is thinking in sync and in line with, okay, you know what, this is where we are. This is where the African startup ecosystem has been. This is where it could potentially be. And these are the things that we need to do to get there. Obviously, taking samples and stories from how other markets have grown. Where we are as a continent is where the US was 20, 30, if not maybe 50 years ago. So we're still honestly in the really early stages of venture capital. I think that we only crossed a decade of VC maybe 2 years ago. So we're just honestly in the really early days of venture capital on the continent. So there's a lot of growth that needs to happen. Sort of people coming together, getting aligned with the vision of what the African ecosystem, the African investment landscape needs to look like in the next 50 years, and just planning for that. That's what needs to happen now.
Okay, so let's go back to the aspect of a few other challenges aside from regulations that we get to face. We're talking about the found this aspect. Some of them actually say that raising global capital, as good as it actually comes, it also comes with another challenge. That's global competition for talent. It's more like once a startup grows,
Mhm.
talents begin to get poached, it gets outsourced or migrate. Do you think global capital helps solve Africa's talent problem, or does it unintentionally accelerate talent drain?
Um, I I think it does both, to be honest. Um, I definitely think it does both. I think it has the good intention
Okay.
of growing the African landscape, investment landscape, but has the unintended consequences of taking people out of it because people grow. Um, People grow to where there's opportunity. There's always, in the we always used to talk about um, I'm going for greener
Yes,
pastures. And when you see that where you are, there are places that are greener. People tend even sheep will go to greener pastures.
actually.
So I think that um, global capital has good
Mm-hmm.
intentions, and that it has been spurring innovation, investment locally, but it also has unintended consequences of situations where people see the opportunities of what's going on globally. People see how people others are fundraising and want to live in better environments because they feel like their local environment is not supporting their dreams and supporting their drive, or where they feel like life is easier in another place, but they can still do what they have to do on the continent by being outside, you know, Kenya or Nigeria or Ghana or South Africa. Um, so I think it's a mix of both. And we cannot say, and even in the olden days, in the days of our fathers, many of them schooled abroad. Many of the older people, schooled abroad, went to King's College in London, went to Columbia University. Many of them schooled abroad, but came back. And so, even if we think and we know that talent is leaving the continent as a result of searching for better opportunities, our hope is that all of the opportunities and all of the education and intelligence and knowledge that they have comes back to the continent, and that people that are on the continent, whether it's regulators or politicians, have the best interest of the people at heart and are growing the economy and the countries in a way that inspires other people that are outside to come back. That's the best thing that we can do because we can't restrict people from leaving. There's so many things, policies that have been put in place now that sort of restrict that in various countries, but it still doesn't stop those that are currently outside from making sure that they're looking in and saying, what more can I do? Yes, I'm outside and I have all of this knowledge and I have all of this money. What can I do to ensure that people that are on the ground are taking advantage of the knowledge that I've gotten by leaving the country? And I think that's really where, as a country, as a government, as regulators, that's where we need to be focusing our attention, as opposed to preventing people from living, because it honestly is going to be very
You know,
difficult.
actually, when we talk about this whole mantra of we always going out to go search for greener pastures, it's funny how we don't get to think, irrespective of the restricting policies that we obviously have in Africa, Nigeria, and other African countries, we don't always get to think about the fact that if the investors that we get to see, global investors that are coming into the country to obviously invest, are they not seeing greener pastures here too? Before they would obviously think of investing. How much more that why
um
is it then so hard for we ourselves that actually belong to this particular country to seem to say, or rather to see the same greener pastures that most of these investors are saying? Like I said, I wonder, it's just more like a rhetorical question. Why can't we also see these greener pastures the same way that these investors are seeing obviously some sort of greener pastures before they could come down here to invest? But okay, away from that, you wanted to say something about that?
no, it's I think everybody sees greener pastures. I think people will definitely need to come to a point in time where they feel like they're comfortable enough to return to the continent and give back. And even, for me, that's one of the things I always think about. How can I make sure that when I speak to people that have been here, been in the US, um I'm always trying to direct the attention to what are you
Yeah.
doing to make sure that the continent is
Yeah.
growing, that the continent is growing by you being here.
Yes.
What are you doing? And that's something that you need to think
Mm-hmm.
about. Um, so I think that again, in our own world and things that we do, I think investors definitely see why people
Okay.
leave. But the truth is, also once you fundraise and you raise from investors, there's a presumption that you do have to be on the continent at least for a certain period of
Hmm.
time in the year, because your customers are on the ground and you need to be speaking to your customers. You need to be on the
Yes.
ground to have that. You cannot be building a business from Europe or from UK and say that your business is in
Yeah.
Ghana. There has to be that back and forth. And if you're ready to make that back and forth, yes, that's great. But you definitely need to be on the continent because you can't build a successful business without being on the continent. That's just the truth.
Okay, so now we've addressed one of the challenges that some of the founders actually get to talk. Let's trace it back to the investors because often most of them actually say that Africa's biggest challenge isn't talent or innovations, it's exits. The exit pipeline is still thin or pretty much sometimes doesn't even exist. And without exits, capital doesn't recycle. So, how can we make Africa's exit environment strong enough to convince global capital that this ecosystem is obviously truly scalable?
So no, I mean, there's been a lot of concern about exit and very valid concerns also. Because the truth is, where there are no exit, then there's no growth. When angel investors are not exiting, when smaller funds are not exiting, when PE funds feel like there's not enough, there are not enough businesses to invest in, the growth on the continent really just stalls. Um, but one of the things that people have said, just thinking about is what are we doing? What are we not doing? I was having a conversation with someone yesterday and I was saying, and also just talking about exits, and I was saying that what are the opportunities that exist around exits out there that as a continent and as investors we're not really looking at. So there's been a lot of drive about local listing on the Nigerian Stock Exchange, listing on the London Stock Exchange, listing on the Johannesburg Stock Exchange, and even just sort of local listing exchanges across the continent. How can we ensure that we're building businesses that can list, that can get people the money that they need, people that have invested in these markets? The other thing is also just creating opportunities for bigger corporate organizations to see these opportunities, to see these businesses, because many of them don't even know about them. Many of them don't know that they exist, except they have a team that is specifically dedicated to looking for opportunities with smaller businesses that they can acquire. But one of the things that I really think is missing is how the entire continent does not have a centralized database. And again, it doesn't have to be one database, it could be several, that is country by country, for opportunities, for acquisition opportunities. That is such a huge opportunity that we're missing on the continent. It's something that I started to think about, last year, about building a centralized database. It's still something that I'm still looking to do and to build. I've started to put together some data, but it's also so much work to ask people to, list the opportunities. If you do want to get your business acquired, what we will do is conduct due diligence into those businesses and then put them on a platform where we say, you know what, we've done the legal due diligences on these businesses. If you're looking to get them acquired, obviously please still do your own due diligence. But these businesses are verified, have been verified by Diligence Africa. There's a report that we've also attached to it that helps people see what these businesses are doing, where they are at the moment, and we've sort of validated that, and we've done it across different, at least the major investment countries in Africa. That is such a huge opportunity for anyone who's looking to take that up, because I think that when people cannot find opportunity, it's difficult for you to say, oh, the opportunity exists. Because sometimes even the data for the opportunity does not exist. And that's one of the things that we're currently dealing with in the country, where the data for acquiring businesses is just not available for investors to look at or for corporate organizations to look at. So I think there needs to be more intentional actions and activities around exits on the continent. There's been a lot of conversations around it. I know many people, many investors that I know are thinking more deeply about how can we engineer and design for exits right from the get-go, right from when we're making investments. What kind of relationships do we need to build for our portfolio companies, for the businesses that we know, that can create an environment where we're starting to see a lot of acquisitions in the investment landscapes. And it's not just for local, sort of local investors or local corporate organizations, but for also foreign. How about we go on a road show, take about like 20 Kenyan businesses or 20 Ghanaian or Nigerian businesses, go on a road show from Europe to the US to Asia, and speaking with big corporate organizations that are looking to come into the African continent and don't have a footprint and are looking for, oh, how can I get into the African continent? But then they see this company that has come to their roadshow and they're like, we'll buy you, right? Why can't we do that? So those are things that I'm starting to just sort of talk to a lot of people about. What can we do to start to design and engineer exits right from the get go for the African continent, and not just even for for your own portfolio companies, for the entire investment landscape. So I think those are opportunities that exist that we're not sort of currently tapping into, that needs to be done. But I know there's been a lot of conversations around local listings, buyouts, secondary sales. But I think that we need to look more deeply about what else are we not doing? What else can we do to make sure that this is actually reality?
Yeah. I must say, obviously, first things first, I must commend your work at Diligence Africa. This is obviously shown that this is not just something that you're starting up or you started up just to follow the trend, but something you're obviously passionate about. And I have obviously seen a lot of work and amazing results that Diligence Africa obviously have put into a lot of startups, and I must commend you on that. And of course, secondly, I would say that this has been a really brilliant and thought provoking session. I think one of the few ones I've had this month, I would say. So thank you so much. Well, before we get to wrap it up, I have one more question for that. Pretty much maybe that pre-series or pre-series A founder that is listening to or watching this conversation right now. If they had a few minutes with you, what are the three things you would insist they fix before taking investor money? And for an international investor, obviously, since we're working on both sides, looking at African deals, what three changes in due diligence approach would you think would make them better partners?
I think for founders, it will definitely be your financials. Oof.
Okay.
Financials are such a big deal. And I think that a lot of founders underestimate
Yeah.
how critical your your financials are to you raising capital. I think that many founders don't take it seriously, and so they don't have accounts for finance team members. They are generating money. The money is going somewhere. The money is being used, but nobody knows where the money is going. Um, I would say fix your financials. Fix your financials and your taxes. Will be the first one. The second would be fix your governance. And governance is not just having a board, it's having people that you're accountable to, because it ensures that it holds you as a founder accountable to other people. And that means that when you're accountable to other people, people also are accountable to you. And you're able to gradually build steps of, okay, reporting steps, and even just controls processes within your company that you think are doing okay. Honestly, they're not. I would say fix your governance. If you can get an external party to come and look at your financial controls, to conduct due diligence on your business, I would absolutely advise that you do it before you go out to fundraise, because the fundraising environment is getting tougher. Because even investors have the tougher end of the stick, because they are not raising money easily, and so when they conclude their fundraise, I don't want to say they divert all of that energy to you. But the truth is, there's more scrutiny because of how long it took them to raise money. There's a lot more scrutiny that investors are now attaching to due diligence than they used to before, because of how long it takes to fundraise. Minimum amount of fundraising for investors is 18 months. It takes them at least 18 months to fundraise. So almost the same time that it takes founders to fundraise. So people are not those are not things that investors take trivial also, because they also have to account for the money. And I think that that's one thing that many founders don't think about. Investors have to account for the money that they're giving you. That means that you as a founder has to be accountable to those for those funds that they're giving you also. The third thing will be reputation. Just if you have a bad reputation, fix it, because people know, we speak to people. If you have a bad reputation, fix it. Whether it's with your employees or whether it's people that have worked with you before. Obviously, people have worked with you before. There's nothing you can do. If it's former employees, there's really nothing you can do.
Okay.
But you can definitely start to make a change now
Yes.
for the kind of person that you are.
Yeah.
One of the things that
Yeah.
would be identified as a red flag for reputational risk is how often people leave your business. Your
Mhm.
employee churn. Once your employee churn um is out of this world, it's not like, if it's like once every month somebody leaves your company, there's a problem. If it's once every 3 months,
Yeah.
it's not too bad. If it's once a year, that's great. But it's if it's every other month, then it's a problem. So you also need to fix your employee churn. Um, on the investor side, I would say that obviously being more intentional about due diligence, looking into other areas of due diligence. We're starting to see a lot more investors just be like, we need you to help us do this. Yes, we can do it, but we want an external party to make sure that what we're doing, we're validating the numbers that we have, because sometimes investors are so ingrained into the business that sometimes there are certain things that you miss. And so when you have someone who comes in from an independent perspective, who's independently looking at the business, who has no ties to you, has no ties to the founders, there's almost nothing that can go wrong if they do their job well. And so that's the role that we play. I would say also for investors also, supporting the growth of businesses. Many founders need help to grow their businesses. And a lot of that is one of the things that we have been trying to advocate for, is technical assistance for businesses. It's how investors need to create, and it's not even just investors, it's corporate organizations, it's foreign organizations that are investing locally, create a pool of technical assistance to support businesses on some of the issues that they have. So, for example, a CEO with no finance background has struggled to hire a finance person because sometimes they don't even have the money to pay. And a lot of finance people obviously are looking for money. So you getting access to capital that allows you to pay for that person or train your team on finance controls, budgeting, reporting, planning has become so critical now. And so those are things that we're asking investors to look more deeply into, whether you're an investor locally um, or a foreign investor or an organization. Many of the companies that we work with do this. So sometimes we work with GIZ. GI, this is the German government, the Ministry of Corporation, I think. They have technical assistance that supports businesses on how to be better entrepreneurs, be better founders, build better companies, build scalable and resilient businesses. We also have funds like Medica VC. They reach out to us for us to provide trainings for their portfolio companies. So we're starting to see a lot more VCs say, we want you to train our portfolio companies because we identify that these are some of the needs that they have. A lot of accelerators are also doing that. 500 Global is doing that also. So you have situations where a lot of accelerators and businesses are reaching out to other third parties and saying, we know you guys are the experts. We know you guys have done this for 10, 15 years. Please come and help train our businesses and work with them so that they can have a structure that allows them to build global and scalable businesses. But we honestly need a lot more investors to do more of that, because I think that that is one of the ways that we can grow our businesses on the continent. If we're not building scalable and resilient businesses on the continent, there's no growth for anybody. There's no growth for
Yeah.
us.
Yeah. Of course, there isn't. It's been a remarkable time
Thank
with
you.
you, Damilola, on the show. Obviously, you've obviously opened our eyes to the The dark spots of due diligence that we obviously did not even know. When I say dark spots, it's more like there wasn't much light
Yeah,
obviously shared on that aspect. So it's great to actually know that there's a lot to learn, and this is obviously something that we cannot obviously take away or downplay the aspect of starting up companies or any other businesses for that matter. It's been an honor having you on the show, Damilola.
my pleasure. Thank you so much.
Thanks to Damilola Thompson for pulling back the curtain on the often invincible work of diligence. If Africa startups are obviously going to build real, durable companies, founders, investors, and policymakers must all change how they measure, report, and support growth. Now, that's Tech Fashion Special for today. Tell us where you stand. Is due diligence enabling or strangling Africa's potential? See you in the next episode.